Good afternoon, ladies and gentlemen. I think it's always a challenge and someone has to take the hit to being the first speaker after lunch. And then particularly the other challenge is probably talking about the more general framework related to financing mining projects. The initial topic that I was requested to talking about was talking about the key success factors for foreign mining investors in the Middle East and Africa. I kept it a little bit more general in, not repeating what may have been said by other financial institutions earlier today or is covered tomorrow, but putting a special emphasis on those subjects that are a key element from a multilateral financing institution. So first of all, thank you for joining me and that I'm not just presenting this to myself. So then let me challenge, the challenge is technology. Let me do it this way. Let me start in giving you a brief snapshot on where we see the state of the market and what we believe are the key drivers currently in the following subsets. One is, well, if we look at the market characteristics at present, we are certainly facing a very depressed commodity and precious metal price market. But at the same time, we are also facing an increasing demand from stakeholders and various groups involved in any mining project. So then at the same time, we are also facing a subdivision of the industry by majors and second-tier mining companies into juniors. And many of the, particularly the juniors, are currently in a state where it is extremely difficult for them to raising any financing. We also see substantial changes in the respective management teams. There's a far higher degree of cost consciousness. Project priorities are redefined. Locations are redetermined in function of perceived political risk changes. And all this is also driven by, well, if you look at how the industry had increasingly to move to geographies that initially were not necessarily the primary target of mining companies. So the industry has moved into geographic regions that are just more exposed to risks and therefore have also substantial additional requirements on the infrastructure in order to bring products that are produced out of mines out of their location. And I will come back to that part throughout my speech in several different contexts. But it also is a time when there is a continued need to dealing with earning the license to operate, as we call it, or dealing with subjects as corporate social responsibility, and thereby a strong need by mining companies to continue investing in communities. And this is by no means limited to companies already in production. It is very much also, covering the entire phase of the exploration phase as well. Coming back to the commodity prices, we have a period of structural oversupply, and it will take a while until those are brought back into balance. And I remember, just a few years back when everybody was talking about, well, are we going through a super cycle in the commodities? Are the historical volatilities that we saw in the commodity sector, are those times over? I think the last 2-3 years have taught us that we are in a market as we had always been. Maybe the upside and the positive momentum on commodity prices and the extent also to what the commodity prices raised during that period of time was more significantly than in past cycles, but we are facing a much more challenging time right now. And this goes across commodities, precious metals, Gold is off 30% from their peak. Copper and iron are down by 30 to 50%. And all this is very strongly governed by the expectations in growth rates, be it in the emerging markets and large economies such as China, India, Indonesia, but also Brazil, South Africa, and Turkey. But it's also very much driven by the lackluster recovery after the global financial crisis in the developed world, where the US and Europe have not come back or just barely made it back to the production potential that these countries had or regions had prior to the global financial crisis. But there seems to be a light coming up at the end of the tunnel, and certainly there is stronger growth in the US than there is currently in Europe, and we hope that this development is going to continue. But the recovery remains uncertain in a number of dimensions. It's on the one hand side, if you look at some of the economies that I was just referring to, the growth rates are significantly below the rates that we have seen, say, in 2007. Namely, even more so when I look at countries like Russia or the European area, where growth is far behind what it used to be in 2007. But also, we will, in our view, see a much higher volatility in commodity prices, derived from that in revenues and profitability, and ultimately also in asset prices. So that volatility will continue, and it will have implication onto what type of mining projects ultimately will be able to successfully raise financing. But it's also very crucial for defining which are those operations that will make it successfully to weather the storm of that down cycle, as we have seen it in other cycles previously. But then there are also a significantly impact of geopolitical developments. We should definitely not underestimate the recent outbreak of Ebola in West Africa, and as much as we all hope that this can be confined to the 3 countries currently affected by it, it's by no means yet clear on what the larger impacts are, at least on the economies of these 3 countries. Tensions in the Middle East and then sanctions to countries such as Russia are certainly contributing to a general framework which is just showing higher degrees of complexity. But all this is also creating opportunities for a number of companies, particularly, and that's a focus from IFC on supporting mid-tier and junior mining companies in emerging markets. So, and there's a strong need to identifying those champions amongst those companies, because exploration expenditure and exploration success is ultimately the fundamental basis for the future mine developments. Without exploration, we won't have future mines. And those exploration expenditures have dropped significantly by 30% in 2013, and it is expected that it will drop further by another 10% this year. I spoke already about the need for the adjustment of oversupplies of various commodities and assets. There is a strong refocusing on geographies where simply certain jurisdictions have proven to be extremely difficult for junior mining companies as well as larger mining companies to operate in. I am just referring to one example. When you look at the major copper project in Mongolia, well, the discussions about its financing have been ongoing now for almost 6 years, and there's still uncertainty as to when the main debt financing is actually going to kick in. And this has largely to deal with the level of government intervention and involvement in this project. And we see that, and for that, by no means Mongolia is different to many other jurisdictions. You see that there is an increasing demand from stakeholders, and particularly also from governments, to participating in the benefits and the long-term revenues of extractive industry projects. At the same time, all this is somehow creating the foundation for a future fear that supply shortages will occur at some point. So by no means the more reserved views that we may have on the mining sector currently, we will go through that down cycle and we will see the emergence of a new upswing. The question is more of when that's going to happen and less so if it is going to happen. In the end, investing today is essentially giving any investor a strong position in a company, being prepared and ready for any development in the next cycle. But let's also be very clear about it. Only the financially strongest and disciplined and the best technical projects are those that will be surviving and making it, and therefore there will be a very strong and high level of selectivity in the process. If I were to give you a snapshot of what the key challenges are for the mining sector globally, I would subdivide them in two main categories. On the one hand side, you see that there's what I would call and define as hardware challenges, which is getting the access to geological data, essentially to build a mine, or to get access to core infrastructure that is necessary in order to get producers, first the project built and then ultimately the producers out of the mine location. And ultimately it also requires financing, and financing needs to be increasingly innovative in terms of tapping new sources, as traditional sources, traditional bank debt, and even equity is currently either not available or only available in very small amounts or for very selected projects. On the so-called software challenges, these have more to deal with what I would call political risks, dealing with bureaucracies, getting technical, environmental, and social permits, and dealing with the regulatory environment. It has also to deal with very strongly in building the workforce for the future that is able to support mining activities and train those people that are legitimately asking for jobs in these mines. So if I were to look at the traditional overview that Ernst & Young is preparing, I think almost on an annual basis, there are a selection of key business risks that have been assessed for the period going forward. And if I were to then subdivide them into those where we believe the IFC, the International Finance Corporation, or the World Bank Group as a larger group can provide assistance, I would suggest to particularly look at those highlighted, because IFC has very strong experience together with the World Bank on, for instance, facilitating the development of large infrastructure projects, which always face the challenge that if you burden the infrastructure cost on the mining cost, then the mining projects are very difficult to get financed and developed. So one of the challenges is how to bundle either mining projects in order to then using that common infrastructure, or how to best implement the infrastructure and make it available to any of the projects that are requiring its access to it. And I come to specific projects later on. So the World Bank Group, IBRD and IFC are seeing it essentially more and more as a partner for shaping projects that are difficult just for the private sector to develop by itself. This requires time and significant resources to shape those projects. And if coming back on the infrastructure subject that I referred to earlier on, if you were just to take the iron ore sector, and if you were to look at a couple of countries that have multiple mining operations, at least many of them, and you look at what the estimated infrastructure costs are that are needed in order to bring that iron ore out of its iron mine to a market, meaning that you have to transport it at least to a coastal line and then through a port. And you put those infrastructure requirements in relation to the GDP, you see the fundamental challenge that these projects are facing and from our perspective as a development finance institution, you see ultimately also the benefits that if you get those pieces of infrastructure in place, what the long-term developmental impacts would be for those countries. They would generate significant revenues for those countries in terms of, well, tax revenues, but also in terms of employment opportunities and indirect employment. So it will be a major requirement for those projects to proceed, to finding partners that are willing to consider developing those pieces of infrastructure for the benefit of the long-term development of these countries. And that's where we feel as an institution best placed for. But it's also, staying with another dimension, what is required to building future mines is to better managing expectations and particularly around the sharing of benefits. Because while communities will require seeing tangible benefits out of what is happening in their backyard. They want to see an improvement in infrastructure, they want to see better education for their children, and they definitely also want to be part of better health systems. So how to address those, particularly in the early stage when the project is still in exploration, where no revenues are generated, but essentially work is already going on in the ground. How do you best manage those expectations? And it has largely to do with building, first of all, relationships with different stakeholders, but it is also about being very transparent, very clear about what is going to happen at what point in time. And as we all know, exploration may take 8, 10, 15 years before any construction decision is taken. So there's a long lead time that is required in order to get through that process. And it may not actually be the generation of people that is living in that neighboring village today that will immediately benefit. It may be only their children's generation that is going to benefit from it. I've been asked in many instances what is a fair share of benefits and how that should be allocated between the mining company and the public sector. There's no definite answer to that, as it depends all on the specific cases and circumstances. But it is somewhere in the range that, say, anything between 40 to 60% in that range, what should be going to the public sector. And it's a balance that then shall be held by shareholders and, well, the mining company itself. Other than the specific expectations by various stakeholders, there's also a major concern about what are the environmental and social impacts of a mining project. And therefore, there's a strong requirement for providing detailed studies, particularly baseline studies. These are not for satisfying future financing institutions in order to make them ready for providing loans or equity financings, but they are ultimately the legitimation of the mining company for what it is undertaking and serves as a benchmark for being measured against what their promises are in comparison to what they have, what they're actually doing. One key element of that is also that one should expect that local content in the construction phase, but then also employment during the operational phase shall be maximized. And for that, training is key. So for that purposes, educating future staff, be it again during the exploration phase or later on for the operational phase, start early to build and to start train people that could benefit from future employment at the mine or in related services. It is also, I think, by now, it goes without saying that best international practices are not just a buzzword, but they are an imperative for mining companies to mitigate risks, and thereby a sound management system, a proactive management are key elements of any mining operations, regardless of whether it's a junior mining company or a larger one. So if I were to just give you a snapshot of key dimensions that we see typically involved in mining projects, then any project has to deal with governments, locally, regionally, as well as the central government. You have a number of constituencies coming from local communities, villages surrounding the project, but then there's also typically a form of NGO activity, and there are the employees themselves. Many of them have been addressed in parts of what I had been saying earlier on. The balance between all of them, so you cannot just say, well, in my case, it's only the government that is relevant. The issues about employees and their expectations and demands come only later. It is really this holistic approach that is necessary in order to create a successful project. Again, not just solely for its financing, but also for its future operation. So in summary, I would like to give a couple of recommendations as we see it from the international financing perspective. In order to see large infrastructure-related financing requirements successfully be managed, it is recommendable to establishing early on public-private partnerships, and also to consider increasingly on how the infrastructure that can be built can be shared. I would even go one step further in saying, well, it's also a question to what degree could several other mining companies that do not yet have processing facilities in the location share that processing capacity, and thereby extending the mine life from a processing perspective. Particularly for these larger projects, and as we all know, grades falling, we would need to think about how to create size, and size is not just by one single mining project in one location. Geology is challenging, and for that reason it is not always doable and feasible to bundle mining projects, but to the extent that they exist, they should be explored more. The second element I would like to focus on is transparency and communication. A transparent and frequent dialogue with host governments is key for any project, and particularly detailed presentation about the economics of the project, but also its timeline. Disclose documentation early on, and thereby making information readily accessible to various stakeholders, helps in shaping contract terms and scenarios, and thereby helps managing expectations from multiple stakeholders. We have talked about the sustainability and the need for incorporating basic management systems in that regard, as they reduce risk and provide the basis for dealing with any kind of unexpected development. Engaging with community, build a strong and sustainable relationship with local communities through an active stakeholder engagement plan. Again, this is nothing that could wait until the project is ready for construction. It starts with exploration. And ultimately, there's also a strong advantage in building strategic partnerships, both for financing, but also for building a very strong and solid foundation in terms of lining up with reputable groups that give credibility to projects, even at an early stage, and it gives ultimately the project and its partners the stamp of approval and the support for its development. With that, I would like to thank you from my part, and if you have any questions, I'm happy to take them.
Thank you very much. I think we have a question right down there at the floor.
Thank you, Karsten. My question relates to particularly the hydrocarbon-focused countries in the region. if you were going to generate a domestic mining industry rather than foreign investment companies coming in, how would you recommend that countries do that? And I'm thinking from an investment perspective, if you're setting up parameters that would ultimately make domestic mining companies attractive, what would they need, and how would the IFC recommend or be willing to assist?
I would respond to that in the following way. I would say that regardless of whether an exploration company is domestic or foreign, what it requires is access to geological data. And then, of course, it requires teams that have the ability to interpreting those data and define on when and where additional exploration shall be undertaken. So it requires a certain level of expertise. Depending on which country you're referring to, that expertise exists in the country or may need to be built up over time. And so it's a question, if it doesn't exist, there need to be an environment that is conducive to having that expertise attracted from foreign countries that then help develop that expertise with local partners. And I would say, and that's part of my presentation, maximizing the local content on whether it is developing lab capabilities or whether it is participatory engagement by stakeholders in the evaluation of baseline data. There's always a strong collaboration between external or international partners and domestic partners in any project at any given time. The question is more on how you elevate that local expertise that ultimately independent, locally driven shareholder structures, company setups, and then mining companies start operating in that environment. IFC, from its perspective, we do not differentiate on whether a project is run by a local partner or by an international partner. For us, the key element is that the basic principles of what I just described in terms of requirements for long-term sustainable mining development, which requires a certain set of values that you share with the management and the company that IFC is targeting to invest in, that these are aligned. And therefore, we would be open for funding local companies, regional companies in a similar way as we would finance any international companies. This being said, being a global development finance institution, there's only a limited capacity that we do have in terms of looking at projects. And to some degree, in order to assure a long-term developmental outcome of IFC's investment in the mining sector, we are looking at typically any company is looking for world-class deposits to being developed. So world-class deposits in some country contexts have a different size and a different meaning than in others. But in all fairness, I have to say, well, we have to apply that selectivity from our perspective.
Great. Okay, one more question from the gentleman in the front.
Thank you. Is the IFC able to invest in Eritrea?
For that, I would have to come back to you. Yeah, and this is simply because my regional coverage does not include Eritrea, and given the regional developments, I just need to double check on what part we are talking about. So let's have that conversation bilaterally.
Maybe just one quick more question. Yeah.
Does IFC also take equity stakes in the early phase, so before bankable feasibility study, and also in the carbon industry?
So indeed, IFC does provide equity, and we have built a quite substantial portfolio of what we call early equity investments, typically with the sweet spot being around the time when a pre-feasibility study confirms that a discovery has been made, but you do not know at that point on whether it is economically viable. And therefore, we would then assist, say it is a junior mining company, in providing funding for continuing exploration, as well as providing, finalizing any feasibility study work. And as partner, we would then also provide guidance and support on the environmental and social dimensions in order to building the management systems that are required from our perspective to satisfy our standards, and thereby preparing the project to a point that when the bankable feasibility study is completed, that then the project is fully compliant with the environment and social performance standards.
Great. I think we need to go on to the next speaker. Thank you very much, Karsten.
Thank you.
Please give him a hand.